Hello traders, you're welcome back to the Forex Geek channel. So if you have been using traditional moving averages, it is time to upgrade your trading game. Okay, let us talk about the Jurik Moving Average Indicator. Alright, so we're just going to add this to the chart right now. The Jurik Moving Average Indicator. I'm just going to change the period to something more so we can see it more clearly. All right. Okay. Now, this indicator is a tool that smooths price action and helps you detect trends with precision. All right. The Jurik Moving Average, or JMA for short, is a sophisticated moving average that is designed to adapt to market conditions. Okay, unlike the simple moving averages or exponential moving averages, which have fixed calculation formulas, the JMA adjusts its sensitivity based on market volatility. All right, so this means it can respond more quickly to fast moving markets and filter out the noise during quiet periods. Now, JMA was designed by Jurik Research, all right, a firm that is known for creating advanced indicators that focus on market dynamics rather than just raw data. Okay, so how does it work? The Jurik Moving Average uses a formula that applies a dynamic weighting scheme, which makes it smooth. It smooths the data differently than traditional moving averages. As a result, you get smoother curves with fewer whipsaws, meaning fewer false signals and a clearer view of market trends. For instance, when the market is moving quickly, the JMA reacts faster than other moving averages. When the market is consolidating, it reduces its sensitivity, helping you stay in a trade longer without being whipsawed out. So in short, the JMA, that is the Jurik Moving Average, adapts to the market's behavior, giving you a more accurate reflection of current price trends. All right, the Jurik Moving Average is perfect for active traders who want reliable entry and exit signals. Okay, basically, bullish signals occur when the price is above the JMA and the JMA line is sloping upward. All right, on the other hand, bearish signals occur when the price is below the JMA and the JMA line is sloping downwards. All right, also, you look out for the coloring. Obviously, when the color is green, it shows bullish momentum, right? When the color is red, it shows bearish momentum. Okay, now when the price crosses above or below the JMA line, it can indicate potential entry points. For example, a crossover from below to above might signal a buy opportunity. So this was a good time to buy, considering the fact that the JMA was sloping upwards, price crossed above it, and the color was green. So this would have been a good entry point. Stop loss can be below the previous swing low. Take profit can actually be around resistance zones, around key resistance zones, or you can decide to wait for when price will cross below the JMA. So when price crosses below the JMA, you can then, sorry about that. So this is entry point. This is entry point, right? This is stop loss, and then take profit can be around resistance, or when price crosses below the JMA, then you exit your buy trade. Okay, the reverse is the case for a sell. All right. However, the key advantage of JMA is that it smooths out price action, reducing the number of false crossovers that you typically see with other moving averages. Now, why should you use the JMA in your trading strategy? One is smoother signals. JMA removes much of the noise in price action, and that makes it easier to spot real trends. Okay, and now with respect to adaptability, the indicator adjusts to fast and slow moving markets, providing more responsive signals. All right. Now, talking about false signals, traditional moving averages tend to generate more false crossovers in volatile conditions, right? Now, the Jurik moving average helps you avoid these, keeping you in trends longer and reducing unnecessary exits. So, JMA is especially effective on shorter time frames where the market is constantly shifting. Okay, it helps, traders stay in trends without getting shaken out prematurely. Incorporating the Jurik Moving Average Indicator into your trading setup can transform how you view and react to price movements. Its ability to adapt and filter out noise means you'll be trading with greater precision and confidence. Okay? Meanwhile, ensure that you do not neglect risk management. Do not trade with an amount you cannot afford to lose. Do not risk more than 1 to 2% of your account balance in a single trade. And ensure that you use good risk to reward ratios. Like in this example that I gave, you can see that the risk to reward was good enough. Before you enter a trade, ensure that you have calculated your risk and your potential reward. And let your potential reward be at least times 2 of your risk. So if you are risking 10 pips, your potential reward should be at least 20 pips. All right? So you want to have a risk to reward ratio of 1 to 2, 1 ratio 2 minimum. Right? Minimum of 1 ratio 2. Okay? So even if you have equal number of wins and losses, you're still going to be on the winning side. Imagine you win 5 trades. If you're risking 10 pips per trade, if you imagine you lost 5 trades and you are risking 10 pips per trade. Out of 10, you lost 5, you won 5. Because you are risking 10 pips and you are always making 20 pips when you win. So if you lost 5 trades, you lost 50 pips, and you won 5 trades, you won 100 pips. So at the end of the day, despite your 50% win rate, you are still in profit, a profit of 50 pips at the end of the day. So that is the essence of, that's the importance of good risk to reward ratios. All right. So if you enjoyed this video, if you enjoyed this breakdown, like the video, subscribe to the channel for more trading strategies, and drop a comment below to share how you are using the Jurik moving average in your trades. Let us stop guessing the market and start understanding it. Cheers and happy trading.